It is now beyond debate. For years we have watched, analyzed, and debated. We studied the charts, we tracked open interest, we made educated guesses. We said the banks would eventually crack. We said the naked short positions would one day be trapped so violently that the entire financial system would be forced to submit. We argued that bullion banks were dangerously over-leveraged, running a reckless fractional reserve paper game against a finite physical supply. Until this morning, however, all of that remained theory. A strong probability, yes, but still missing proof. There was no smoking gun, no body. That changes today. The guessing ends, the speculation ends, the body has been found. While everyone was focused on the silver price, watching spot silver surge to $77.16, celebrating the breakout and recalculating personal net worth, something far more serious was unfolding behind the scenes. Deep inside the plumbing of the global financial system, something darker and far more alarming was taking place, something the mainstream media is desperate to ignore because it exposes beyond any doubt that the banking system is fundamentally insolvent. Official data released this morning from the Federal Reserve Bank of New York shows activity in their overnight reverse repurchase agreement facility, the repo market, for Friday, December 26th. The number that appeared on the screen was neither a mistake nor a glitch. It was a confession, $17.251 billion. In a single morning during the quiet hours immediately following the Christmas holiday, banks deemed too big to fail rushed to grasp the significance, you must understand what the repo market truly represents. This is not a place where healthy institutions go to fund growth or finance new opportunities. It is not a routine source of capital. The repo facility is the financial system's pawn shop of last resort. It is the emergency room you enter when the patient is having a heart attack. A well-capitalized bank with a clean balance sheet avoids the repo window at all costs. Strong institutions borrow from each other in the interbank market. They rely on peers, not the central bank. Staying away from the Fed's window is a point of pride because using it signals distress. It is the banking equivalent of a public walk of shame. So the real question is this: why the day after Christmas? Was it for payroll? No. Was it to cover routine operating costs? No. They needed the cash because they were hemorrhaging. They needed it because they had just been hit with what may be the largest margin call the commodities market has ever seen. Follow the trail, study the timing, it's flawless. The day before, silver gapped higher. Overnight, it rocketed straight to $77. The banks are buried under massive short positions measured in the hundreds of millions of ounces. They sold those contracts at $30. They sold them again at $50. They sold even more at $70, convinced they could cap the price like they always have. They believed they could scare retail investors, trigger stop losses, and buy everything back at lower levels. But that plan failed. Retail investors didn't sell. Chinese industrial buyers didn't sell. Physical vaults were already drained. Instead of collapsing, the price exploded upward. Silver now sits at $77.16. Run the numbers. Every single $1 move higher translates into billions of dollars in losses on the bank's books, and while unrealized losses can be hidden, margin calls cannot. For months, those losses were quietly buried. Labeled as unrealized, they were pushed aside with the assumption that prices would eventually fall and fix the problem. The damage was deferred. The can was kicked further down the road. But the Commodities Clearinghouse is indifferent to accounting games. The exchange doesn't care about your outlook for next week. It only cares about solvency in this moment. When prices move $5 against you in a single day, the clearing system calculates the risk instantly. The message is simple: you're underwater post-cash immediately or your position gets liquidated. This morning, that calculation produced a number. And that number was roughly $17 billion. The clearinghouse demanded payment. The banks checked their balance sheets, reviewed their available liquidity, and faced a brutal reality: the cash wasn't there. They were illiquid. On a mark-to-market basis, they were insolvent. With no alternatives left, they gathered their remaining U.S. Treasury bonds, the last acceptable collateral, and rushed to the Federal Reserve. Those treasuries were pawned for overnight liquidity just to survive, just to stop the clearinghouse from forcibly closing their short positions and launching silver toward $200 in an instant. This $17 billion wasn't stimulus. It wasn't support. It was a tourniquet, a last-ditch effort to slow the bleeding before the patient flatlines. And consider the timing. It happened on a Friday. In banking, Fridays are where bad news goes to hide. Banks collapse on Fridays. Regulators act on Fridays. The fact that this liquidity surge occurred on the Friday after Christmas, when no one was expected to be paying attention, reveals everything about how serious this situation truly is. They assumed this would go unnoticed. They believed trading volume would be thin enough that no one would catch the Fed injecting $17 billion to rescue a silver short. But it didn't slip by. We saw it. We're paying attention. And what's becoming clear is that the long-running price suppression machine is breaking down. For decades, the strategy was simple: banks sell paper silver to push prices lower. If prices rise, they sell even more paper. With effectively unlimited paper supply, they always believed they could control the market. But there is one fatal weakness in that model: a liquidity crunch. When you no longer have the cash to meet margin on new shorts you can't keep selling, your weapon disappears. That $17 billion marks the end of the line. It signals the moment banks exhausted their own capital and turned to taxpayer-backed money through the Fed to continue the fight. This completely alters the nature of the trade. We're no longer facing JP Morgan or Citi alone. The opponent is now the Federal Reserve itself. By stepping in, the Fed has become the counterparty, effectively subsidizing the short position. Here's the problem with that approach. The Fed can create unlimited dollars, but it cannot create physical silver. It can keep banks alive with liquidity, but it cannot manufacture metal to ship into the Chinese market. In reality, this intervention only worsens the situation. The dollar is losing ground against silver, and printing more dollars adds fuel to the fire. The result is further dollar debasement, more inflationary pressure, and direct confirmation of the very thesis pushing silver higher. It's a self-reinforcing loop that works against them. Every bailout pushes prices higher. And as prices climb, the scale of the bailout must grow. What we're witnessing is the early stage of a hyperinflationary melt-up concentrated in commodities. This $17 billion is only the opening round. It's merely the visible tip of something much larger. If silver reaches $80, and that could happen before today's close, this sum will be inadequate. Then it becomes $20 billion, then $30 billion. Expect the repo market to surge just like it did in September 2019, following the same dangerous sequence once again. The catalyst is silver itself. This is a hard asset revolt against a system built on paper promises. Critics will shrug and say, $17 billion is insignificant in a global economy this large. That argument misses the point entirely. In the highly leveraged world of futures markets, $17 billion in margin supports hundreds of billions in notional exposure. That's not a minor crack. That's the Titanic's hull splitting open. That's a systemic failure event. And look closely at who accessed the facility. The data may be anonymized, but the identity of the players is obvious. It wasn't regional lenders. Smaller banks don't hold enormous short positions in silver futures. This came from the G-SIBs, the global, systemically important banks, the whales. The same institutions that mocked silver as a useless pet rock are now pawning their most prized collateral U.S. treasuries to survive that pet rock's revenge. This moment vindicates every long-term holder of physical silver, every stacker, every silver bug, everyone who endured years of ridicule and doubt. You were right. You held your ground while they leveraged themselves to the brink. Now the reckoning has arrived. That $17 billion is the receipt. It's hard evidence of fear. Don't let anyone dismiss this as routine year-end positioning. Yes, window dressing happens at year-end, but it happens in the open market. It does not occur through an emergency repo facility for $17 billion on the same day silver surges 5%. The connection couldn't be clearer. The correlation is effectively perfect. This was a margin call, nothing more and nothing less. So what comes next? If $17 billion was required at $77, silver, what happens at $85, at $100? This cannot remain hidden. As repo usage escalates, trust in the banking system will continue to erode. We are staring at the possibility of a banking crisis, sparked not by subprime mortgages or collapsing tech stocks, but by a short squeeze in monetary metals. The market has moved beyond correction. We are now in a phase of outright systemic intervention. The Fed is actively influencing the silver market not by selling metal, but by keeping short positions alive through constant liquidity support. But a system on life support cannot wage a sustained battle. The banks are effectively incapacitated, reduced to zombie institutions that exist only because of the Fed's ongoing drip feed. And zombies can't stop a bull market. They can only stand by and watch it unfold. Price suppression is effectively finished. Their ammunition is gone. All that remains is the Fed's credit line, and the first limit has already been hit. You can create unlimited paper contracts, but you cannot create unlimited margin cash without destroying the currency itself. That limit has now been reached. The leverage ceiling is here. Mathematically, the game is finished. And don't let the dry terminology repo facilities liquidity operations put you to sleep. You need to grasp the harsh, unforgiving math that is crushing these banks in real time. This is about leverage. The kind of leverage that turns a modest miscalculation into a financial explosion. To understand it, you have to remember how the futures market works. A single silver futures contract represents 5,000 ounces of silver. When a bank sells one of those contracts, it is committing to deliver 5,000 ounces, yet it only has to post a small percentage of the total value in cash. That cash is called margin. Margin is what allows banks to control enormous quantities of silver with very little actual money. It is the foundation of their power. It is how silver prices have been suppressed for decades by issuing paper promises that could never realistically be fulfilled. But leverage is a double-edged sword. Let's walk through a simple example involving a hypothetical too-big-to-fail bank. Assume that bank is short just 100,000 contracts. Within the world of bullion banking, that is a conservative figure. 10,000 contracts multiplied by 5,000 ounces equals 50 million ounces of silver. For every $1 increase in the silver price, that bank loses $50 million. A $1 move equals a $50 million hit. Now consider what just happened over the last 24 hours. Silver didn't rise by $1, it surged by $5. It jumped from $72 to $77 almost instantly. That means this single bank on that one position alone lost $250 million before most people finished their morning coffee. And that's just one institution. When you combine the total commercial short exposure, the major U.S. banks plus the largest international players, you're talking about hundreds of millions of ounces. That translates into billions of dollars in losses stacking up in real time. And this is where the trap closes the unrealized loss illusion. Bank executives love to go on television and say, these are only paper losses. We haven't closed the position. Prices will come back down. They treat the market like a casino, assuming they can simply wait for the wheel to spin in their favor again. But the clearinghouse is the pit boss, and the pit boss has no interest in your long-term narrative. The only thing that matters is the value of the chips on the table right now. This is mark-to-market accounting. Every single night, the exchange recalculates the value of every position. When the market moves against you, they don't wait for your trade to close. They don't wait for permission, they debit your account and pull the cash to cover the loss. So when silver touched $77 this morning, it wasn't merely an unpleasant trading day for the banks. It was a forced liquidation event. That $77 level matters because it represents the mathematical point of failure in their risk models. At that price, losses overwhelm the cash buffers set aside for normal daily operations. Their internal value at risk models collapsed. Alarms went off inside risk management departments. That is why the $17 billion was required. It wasn't used to repay debt or expand activity. It was survival capital, an entry fee to keep the clearinghouse from confiscating assets. What we are seeing is technical insolvency in real time. If these banks were forced to close their entire short exposure today, if they had to repurchase every ounce they owe at $77, they would be finished. Equity would vanish. Balance sheets would be erased. They are walking corpses, institutions animated only by Federal Reserve support while pretending to still control the system. But mathematics doesn't negotiate. It is cold, rigid, and indifferent to central banks. That $17 billion only buys time. Maybe a day, maybe less. It does not fix the underlying problem, because the problem isn't cash. Cash can always be printed. The Fed could create $17 trillion if it chose to. The real constraint is the metal itself. While the clearinghouse accepts cash for margin, the counterparties, the holders of long contracts, no longer want dollars. They've seen what's happening globally. They've seen Venezuela. They've seen pricing in Shanghai. A settlement check isn't enough anymore. They want delivery. They want the 5,000 ounces promised in the contract. And this is where financial math becomes physical reality. The Fed can transfer $17 billion in a fraction of a second, but it cannot conjure 63 million ounces of silver out of thin air. That is what the market is now demanding. The crisis has evolved. This is no longer just a financial stress event, it is a delivery crisis. And the figures emerging from recent COMEX delivery reports are staggering. Don't let the dry language of repos and liquidity facilities distract you from the meaning. The $17 billion wasn't a solution, it was an admission fee. It's the cost of staying alive inside the casino. But survival alone is meaningless if you can't pay the winner. And the winners right now, the long contract holders, aren't asking for chips, they're asking for silver. The shift is complete. What began as a financial crisis has become a physical delivery crisis, and the numbers coming out of the delivery data make that unmistakably clear. Earlier today, the CME Group published its daily December delivery notice report. Under normal circumstances, December is a sleepy month. Traders typically roll positions forward into March or choose to settle in cash. But this December is anything but normal. This December looks like a classic bank run. So far, there have been 1,277 delivery notices issued for the month. Each futures contract represents 5,000 ounces of silver. That means 127, 7 contracts equal roughly 63.8 million ounces of silver. Pause for a moment and let that register. More than 63 million ounces of physical metal are standing for delivery in New York right now. That represents about 8% of total annual global mine supply being demanded in a single month from a single exchange during a holiday period. In a normal market delivery, demand is only a small fraction of this size. Typically, open interest collapses as contracts approach expiration because almost no one actually wants physical delivery of 5,000 ounces. Hedge funds trade paper contracts for price exposure, not for metal. But something has clearly changed. Long holders are no longer rolling forward. They are holding contracts through expiration and demanding delivery. This is the industrial panic we have been warning about. The players standing for delivery are not speculators. They are supply chain operators. They are battery producers. They are sovereign wealth funds. They look at supply deficits, they look at geopolitical disruptions like Venezuela, and they reach the same conclusion. We don't want your cash. Cash is losing value. We want the metal. And this is where fear sets in for the banks because they don't have it. Look at the registered inventory inside the COMEX vaults. This is the silver that is actually eligible for delivery against futures contracts, and it has been draining for months. We've tracked metal leaving Asahi. We've tracked silver leaving JP Morgan. Registered inventories are hovering near historic lows. So now we have demand for more than 63 million ounces. At the same time, the vaults are nearly empty of unencumbered metal. That leaves the banks with only one option. They must enter the open market and buy silver. They become forced buyers in a market already pushing into record highs. Picture the position they're in. As shorts, they are losing money every second the price rises. And to close those obligations, they must purchase physical silver at $77, $78, or even $80 just to hand it over to the counterparties who outplayed them. That buying pressure acts like jet fuel for the price. It is compulsory buying. It is completely price inelastic. And the situation grows even darker as reports emerge that banks have begun cannibalizing silver ETFs to source the metal they owe. They are now eyeing the enormous stockpiles held inside SLV and SIVR, attempting to exploit authorized participant loopholes to siphon that metal into COMEX to meet delivery obligations. It's classic rob Peter to pay Paul behavior, but this time Peter is paying attention. ETF holders are watching closely. If ETFs are drained, prices will decouple and shareholders will respond with lawsuits. This is a legal and financial minefield. The Fed's $17 billion injection fixes the cash issue, but it does absolutely nothing to solve the 63.5 million ounce problem. You cannot print a silver bar. You cannot digitally manufacture an industrial metal. The only real way to resolve this imbalance is for prices to rise high enough to choke off delivery demand. But at $77, demand isn't fading, it's accelerating. At $80, it will likely intensify as FOMO takes over. What we are seeing is a Giffen-Good dynamic. Under normal circumstances, higher prices reduce demand. But when a strategic asset is scarce, rising prices increase demand because buyers realize supply is disappearing. The 1277 contracts standing for delivery prove the price is not high enough to ration demand. Silver is still too cheap. If it were truly expensive, holders would be selling. Instead, they are demanding delivery of more than 63 million ounces. This is the potential break the exchange moment. If COMEX fails to deliver, if even a single contract defaults, the game changes instantly. Force majeure will be declared. Cash settlement will be imposed. And the moment that happens, physical silver will completely decouple from paper pricing. You could see paper silver at $80 while real deliverable silver trades at $150. The 1277 delivery notices are the countdown timer, tick, tock. And continuing with this theme of robbing Peter to pay Paul, we need to address the unusual anomaly that appeared today in the SLV ETF. If you don't understand the plumbing of the paper market, you'll misread what's happening. You'll see the headlines and assume pressure is easing when in fact the stress has gone terminal. A headline hit the Bloomberg terminal this afternoon that confused many retail traders. The borrow fee on SLV, the rate hedge funds pay to borrow shares for shorting, fell sharply, dropping from over 1.5% on Tuesday to just 0.62% today. At the same time, roughly 10 million new SLV shares suddenly became available to borrow. Mainstream financial media immediately seized on this. The same CNBC commentators who have been urging investors to abandon silver for years pointed to this data as proof that the pressure was fading, when in reality it signaled something far more dangerous. They claimed, see, the borrow fee is falling. According to them, that means the squeeze is finished, liquidity has returned, and the shorts are relaxed again. That narrative is false. Or if we're being generous, it reflects a deep misunderstanding of what capitulation actually looks like. In this situation, a falling borrow fee does not mean strength. The borrow fee is simply supply and demand for borrowed shares, the rent you pay to short a stock. When everyone wants to short SLV, demand for borrowed shares explodes and the fee spikes dramatically. We've seen this movie before. It happened with GameStop. It happened with AMC. A high borrow fee means the fight is intense. It means shorts are desperate, paying whatever it takes to stay in the game and defend their positions. So, ask yourself the real question. What does it mean when the borrow fee collapses in the middle of a historic rally? What does it mean when the cost to borrow falls towards zero while silver is surging? It means the shorts are gone. It means demand for borrowed shares has vanished. And it vanished for a simple reason: no one wants to short silver here. The hedge funds have run the numbers. They see the $17 billion spike in the repo market. They see more than 63 million ounces standing for delivery. They see geopolitical pressure and physical supply stress. And they've concluded that shorting silver at $77 is financial suicide. So they are giving the shares back. They're closing positions, they're covering. When a short covers, the borrowed shares are returned to the lender, instantly swelling the pool of available stock. That's where the headline about 10 million shares suddenly available comes from. And because no new shorts are stepping in to replace them, the borrow fee collapses. This is not bearish confirmation, it is bullish confirmation. It's the white flag. The short army didn't regroup, it retreated. They surveyed the battlefield, recognized the physical supply damage, and walked away. That psychological shift is enormous. For decades, silver spikes triggered the same reflex price up short at the banks will smash it back down. But now silver jumps $5 and the borrow fee drops. That tells you the reflex is broken. Smart money is terrified to stand in front of this move. They understand the rules have changed. They know the Federal Reserve is now involved. And they know that shorting silver today isn't just betting against a mining company or a chart pattern anymore. It's stepping directly in front of a freight train driven by physical scarcity and systemic stress. Shorting silver now means fighting the U.S. printing press and China's strategic reserves at the same time. There is no edge in that trade, only bankruptcy. That reality is why speculators have surrendered. They've stepped aside. And with speculators no longer stacking onto the short side, who is left to cap the price? No one. The dampening force is gone. The friction that once slowed price advances has vanished. That's why we're seeing sudden upside air pockets. In a normal market, rising prices attract short sellers who fade the move, add liquidity, and slow momentum. Today, silver climbed $5 and no one showed up. The sell-side liquidity vacuum is total. This isn't a spike, it's a repricing. Now, look again at those 10 million shares suddenly available. Where did they come from? In the ETF ecosystem, shares are created and redeemed by authorized participants based on flows. One plausible explanation is that new SLV shares are being created not fully backed by physical metal but by leased silver or paper credits to patch a paper failure during chaos. Even so, no one wants to borrow those shares to short. That's the crucial point. You can make shares available, but you can't force anyone to bet against a monetary metal during an inflationary breakdown. The collapse in the borrow fee effectively removes the market ceiling. Sellers aren't being overwhelmed, they're disappearing. This is a vacuum squeeze. If you hold SLV, this confirms the broader bullish thesis, but it should also raise concerns about the instrument itself. Tracking error is expanding. SLV is lagging spot and lagging physical coins even more. Smart money isn't just exiting shorts, it's rotating. Many are reallocating into mining equities or physical silver. That rotation explains the explosive move in junior miners today.